Hi everyone, I'm Eileen Thomas, the accounting manager at DB Accounting and Brokerage. Welcome to the third video of my tax planning series, where I'll be focusing on income acceleration. So why would anyone want to accelerate their income and in theory pay more taxes? Well, in my personal experience, I've come across two situations that I believe would be most common. The first situation is going to be where you know you'll be at a higher tax bracket in the future. So if there's any income that you know you can tax yourself on now while you're in the lower bracket, that will always be beneficial. Then the other situation would be, say you're a farm and you're at a loss this year. Great, you don't have to pay taxes, but you're also not paying any estimates and you didn't have any withholdings from wages to get refunded back to you. And you're not necessarily going to have an NOL. It depends on where you're at in that loss. So it's not always going to carry forward. So in that case, by bringing income into the current year, you would essentially open yourself up to the possibility of getting a refund of the earned income credit or even child tax credit. So how would you accelerate your income? For businesses, there's always the option of doing the opposite that you did for accelerating your expenses. So you'd be contacting your vendors and seeing if you can pay them in January instead of December. You can also pay your year-end bonuses at the very beginning of January instead of the end of December. And both of these techniques would also only work for cash basis accounting versus accrual basis. However, for cash or accrual, you can always do the literal acceleration of income by invoicing as much as you can in December or reaching out and trying to collect as many invoices before the end of December to help bring that revenue into the current tax year. Individuals also have the option of a Roth conversion. Basically, you're taking a retirement account created from pre-tax dollars and rolling it over or converting it into a Roth IRA. This rollover/conversion is taxable, which is why it's more common in younger people, though not exclusive to younger people, because we know we're in a lower tax bracket. So we're trying to get it taxed now while we're in the 12 or 24% versus in the future when we could be in the 32 or 37% brackets. And this also has the added benefit that a Roth grows tax-free. So if you put in $5,000 now, it could grow to $25,000 in the future, and when you take that out for retirement, you won't have to pay taxes on that. Again, tax planning can be very client-specific, so it's hard to go into much more detail than this, but I hope I was able to clarify some of what we do and maybe help you better understand some of what we're considering when analyzing someone's income for tax planning purposes. In next week's video, I will be going into some of the state level planning options specific to Virginia. But if you have any questions before then, feel free to leave a comment or reach out to me through my About Me page on DB's website, dbaccountingcpa.com, where you can also go to find updated and helpful information related to tax season or any upcoming deadlines. We are also on Facebook, Instagram, and LinkedIn under DB Accounting and Brokerage. See you next time. Schlan!